how do you use this to help you pick winners, avoid losers? I suppose as importantly, how do you make sure you don't fall in love with a stock? You're getting such a long-term view, you manage to sort of discount perhaps some of the sort of weird cranks and sort of sparks coming out of the engine.
Yeah. So we definitely, own companies for a long time, but love is not a word I would use. If there's something that we have, I guess I would say we're rational, we're disciplined, and we have a temperament and a decision-making process that helps us avoid those things. When you think about the direction of a stock, it's actually much easier to understand where it's going to be 10 years from now than 10 months from now. Short-term market volatility is driven by investor behavior. And when I say short-term, 2-3 years is even considered short-term. So really doing the deep dive, looking at it from the structural perspective, looking at the full competitor universe, the global value chain analysis helps us really understand those sustainable dynamics.
So how long has the team been right on a stock and the market wrong, and you've kept the faith and it's come round? Because there must be, as that goes on, that must build pressure inside a team.
Many would have said we were wrong in 2020 by not buying into the work from home bubble. Right? But these were largely low quality companies that were selling well above intrinsic value, many of which did not have sustainable growth. That's an example of recency bias. We were looking at pandemic-led growth, and that wasn't sustainable into the future. So, we are a patient investor, and we bought Tesla last year. We've had the opportunity to add to it several times, as recently as earlier this year. There are concerns about Tesla's market penetration in China. There are concerns about their market share. But you have to look at these in the context of the facts, not the headlines. First of all, when you look at market share, well, they've been one of the few players in a small market. The total addressable market is huge, but the number of EVs on the road today are not very many, and they have a large market share. As the traditional automobile manufacturers ramp up their production, there are going to be more cars, and it's going to be natural for Tesla's market share to come down. That's what's going to happen as the penetration gets bigger. But just, quote, market share going down is not the problem. We'll stay focused on the units that they're selling and the growth of that and their ability to attach subscriptions to those. Certainly the experience of 17 years managing a portfolio, what we do, how we do it is really fundamental and core to really how we believe one should approach markets and investing. A good story to sort of exemplify that would be another story about Amazon. It is one of the companies we've held since inception. Over that 17-year period, Amazon has experienced 14 stock price drawdowns that were 20% or more, 35%, 42%, once as high as 60%. These short-term drawdowns are driven by investor fear, investor sentiment. Again, as I said, when viewed rationally, right, over the long term, these have no impact on our estimate of intrinsic value. When we can, depending on the portfolio guidelines, we like to buy on price weakness as long as our investment thesis remains intact. Despite these 14 drawdowns, which were regular, if you will, but still completely unpredictable, the Amazon stock price has outperformed the benchmark about 12 times. So understanding what the long-term trajectory is and staying focused on the drivers of that estimate of intrinsic value, we can stay rational even in fear or greed. With a long-term structural growth company, honestly, you never know when today's high might be the new low.
We've talked a lot about successes of the portfolio, but no fund manager gets everything 100% right. So could you give us an example of something where, I guess in the round, you made a mistake? What was it? What did you learn from it?
It's a great question. And first and foremost, before you can recognize a mistake, you have to admit that they can happen. So we're fully aware that mistakes can happen. That's why we're constantly vigilant, looking at our investment thesis every quarter and any time that there is news. So we have low turnover. What are you doing? We're staying on top of our investment thesis to make sure there aren't mistakes. But in fact, we track every sell in the portfolio. About 50% of the time, we sell because it reaches intrinsic value. 25% of the time, we sell for better reward to risk opportunity. Nothing wrong with what we sold. We just found something more compelling. And the last 25% is where there was a mistake in the investment thesis. Doesn't mean we lost money, but we got something wrong. An example of that would be a company that we owned several years ago, a small merger and acquisition company, a very well-run company, boutique. We liked their contrarian view to building teams. What we found over time, we held the company for a few years, is we thought this would be a difficult to replicate business model, but we saw some other players moving in and executing well in that space also, and we decided it didn't have the barriers to entry that we thought that we require really for a long-term position, and so we exited that position and called it a mistake. It's in the mistake bucket.
So let's take Tesla as an example. Let's assume that it's currently below intrinsic value, so you're buying more as money comes into the strategies. What happens when it gets above intrinsic value? Do you sell the whole position and say we might come back at a different time? Do you top slice it? How does that side of the equation work?
So every investment decision that we make, whether it's a buy, an add, a trim, or a sell, is driven by valuation. We scale into position sizes and we scale out of position sizes. So it takes us over a year in each case to build or exit a position. When we build a position, we take a small initial position. The most would be around 2.5%. Typically, maybe it's 100 or 150 basis points. And as soon as we take a position, we hope the stock price continues to go down so that we can continue to add to it at a lower cost. The sell discipline is the exact opposite. As the stock price starts to climb toward intrinsic value, downside risk is increasing while the upside potential is decreasing. So we're going to trim that position, sort of right size it for that position size reward to risk while taking the cash and investing it in something at an even deeper discount to intrinsic value. By the time we actually sell a business, the average position size is about 60 basis points. So, and we sell it, we trim it as it approaches intrinsic value, and we're out at intrinsic value. So we never own anything above intrinsic value. Every day, everything in the portfolio is selling at a discount to intrinsic value. The way to think about it is we are managing the exposure. So someone can buy today and the largest companies in our portfolio are selling at the deepest discount to intrinsic value. So even after the run-up we've seen this year, still significant discount.